Got it.
All
All
right.
right. So good afternoon. It is a wonderful and beautiful Friday here, and I'm here with Matthew Bradey from Greentree Mortgage. Thank you so much for coming to chat with me today about what's happening in real estate and in the mortgage industry. So how are you today?
I'm excellent. Thanks, Patrease. Thanks for having me. It's a pleasure to be here. I love doing things like this, and I applaud you for setting this up and getting this together and doing things like this.
Of course, of course. Well, I mean, I've done so much business with you since I have been in this industry. At least every year, there's at least one transaction that we work together. And so you're one of my top three recommended lenders. And so happy to have you here just to chat about what you know is happening on your end.
Yeah, absolutely. There's been a lot. We've seen a lot of changes, a lot of craziness. From COVID and changing guidelines. And so, yeah, I mean, I'll kind of start from the beginning and try to explain a little bit from my perspective what's going on. So with COVID, obviously we saw mass unemployment. We saw a lot of fear in the beginning from investors. They shot those rates up very, very high, to 4.5s. And then it stabled out because the Fed lowered their interest rate to 0%. And now the Fed's rate is not mortgage rates. Had a lot of people calling asking, oh, rates are at zero. So the Fed rate is what banks trade, between each other. So that means the banks don't have to, pay any interest on money that they lend to you.
Mm-hmm.
So that's why it's good for them. So they're making, they're not having to pay that interest. So they were able to lower rates, keep them low. And yeah, I'm just going to share a screen here.
And this kind of ties in with why we see such great rates, at least for this past year, for first-time buyers or even refinancers. They're seeing these great rates because of this change and the Fed rate being at zero, and then investors having the not really having to pay as much.
Yeah, absolutely. I mean, so interest rates are tied to what you see here, the US 10-year Treasury, right? So as this yield goes up, rates go up. As the yield goes down, rates go down. Because these are bonds. These are traded in bonds. And so what you see, we've actually had a pretty bull market on this. Rates were higher back in 2017, and this continues to go up even further. So the yield has been going down for years now, years. And so that's why you've seen lower interest rates. I mean, it wasn't, this is kind of COVID area right here,
Mm-hmm.
so that's where you'll see the drop. But yeah, I mean, it wasn't until, just before COVID, rates were, 4.5s, threes, and that was fantastic.
Mm-hmm.
So then once COVID hit, you see, a little chaos here, the drop and then the spike. But then you see the major drop, and this is where they leveled out down here. And this is when you were seeing rates in the twos, and they were fantastic. And
Mm-hmm.
that's actually why you've probably seen such a crazy mortgage volume then, because you have people who can now qualify with cheaper,
Mm-hmm.
lower mortgage payments. They want cheaper, lower mortgage payments. So, now is the time to get it. You can get a significant reducing in your monthly payment from those lower interest rates. And so everyone's trying to take advantage of this. And then we saw, it naturally kind of going up, which was normal, and telling people, looking to refinance and everything, try to do it as soon as possible because, the trend is now showing upwards.
Mm-hmm. What
And
was that
then,
spike there that you highlighted?
yes, so thank you. This spike is what happened about 2 weeks ago or so. Because with COVID and because, they're printing out money, investors got afraid of inflation. So we had a major sell-off. The yield spiked up, and that week was rough. Had people who were, quoted a 2.5 rate are now at a 3.5.
Mm-hmm.
But Powell has been saying, because this is usually based off of future predictions, what investors think is going to happen in the future. But with COVID, it's a little weird, situation. Powell's trying to say, like, look, we're not basing decisions based on the future predictions. We have to go by the actual data right now. We need to go by the actual unemployment rates, and not just that, because normally they just kind of go off of that, but it's not the best. They're looking at everything. So the investors were afraid that things are looking better, economy's opening, vaccines are happening. So with the market, the economy opening, there's all this money in the flowing around now. So they were afraid of that inflation. So it spiked up. They're thinking the Fed's going to raise their interest rate from the 0%. But again, he's came on and said, no, we're not planning on raising from that 0% until 2023, I believe he said. So he keeps saying it, but they don't believe him because the economy is recovering pretty well. So that's why we saw that. But it did come down, but the trend is still going upwards.
Yeah.
But even with that, I mean, rates are still, like I said, fantastically low, because you see the yield price here is still, lower than it's ever been. So you're still seeing rates in the higher twos now, not so much the low twos like we saw, but still low threes, which is still fantastic.
What does that mean for, because I get this question all the time, with home purchases or home prices being higher, and there is a very competitive market. Should they still buy? Like, buyers want to know, should they wait it out, see what happens? What does the lower interest rate for buyers mean now versus if they waited with a higher interest rate?
Well, yeah, I still think it's a tough time to buy, but it is a good time to buy. Yeah, even though the prices are getting up, you're still paying less interest on it. And I personally I don't think the housing value market's going to crash. I think it will start to stable out. I mean, it's gotten pretty dramatic during this. We see people going 15, 20, 25, 50. I did a deal going 50,000 over asking. And it appraised, because yeah, we it is good. It's lucky, knock on wood, I haven't had too many come in low value, because I mean, essentially it's supply and demand. So, appraisers take the market conditions into account. And if there is many people, willing to pay that higher price, right, then that kind of supports the value. Plus, you do have other houses that are selling for higher, and the appraisal will go through. So now you have a higher comp. So, it kind of helps support the value. I mean, the tough thing is right now is the inventory, yes. And that's why you're having all those multiple bids, and it's a struggle to get a contract. I mean, mortgage volume is still very, very high. I'm taking a lot of applications, so all day applications, sometimes it's too much. So, we're still spitting out pre-quals and buyers and things like that. But yeah, I'm not getting many contracts. My percentage is low. Usually, the conversion rate is a lot higher than it is now for the amount of approvals I'm putting out. Is because people are having tough time actually getting under contract. And for me, a contributing factor to that is the foreclosure, addendum or moratorium, whatever they call it. All those foreclosures that are being held and allowing the people to live in there because they don't want to kick all the millions of people out at once. If we saw that happen, I mean, it keeps getting pushed back, but if we did see that happen, I think you'll see a dramatic flip in the market where it's going to go from the seller's market to the buyer's market almost immediately, because you're going to get all that inventory, where investors can now start getting in there. Buyers will have more options. It won't be as competitive. So, I mean, I feel terrible for those families that are in foreclosure, and if they do need a place to stay with COVID. But I feel like things are recovering pretty well, that if they structure it properly, I think that's why they keep pushing it back. They don't know how to execute it and go about it. But to allow these people to transition to a new housing, to find a new apartment or something like that, and then you'll have all that inventory. I mean, there'll be foreclosures, but
Yeah.
they'll be recently lived in, so they should be fine.
I mean, that is one of the benefits for sellers. You know, I work with a lot of sellers that are anxious or they're not sure about, you know, if they're in a situation like this where they're behind on their mortgage, it's still an okay time to buy. Sure, you're going to have that negative mark on your credit that says like you can't potentially buy right now, but the values are high enough that you're going to get there should be some equity. You know, we could pull some comps and see where you are, but there's still plenty of buyers out there who are having their loans originated
Yeah.
with lenders like Matthew, who are looking to buy and are qualified, and they just can't find that home. So even if you're in a situation where you are behind on your mortgage, it's a great time to see what's selling in your market, because there are potential buyers who are still looking to buy. So that's good to hear that people are still putting in those applications to get approved, and there's an opportunity still to take advantage of this market for potential sellers or who are behind. So that's good.
Yeah, definitely. I mean, it's a great time to sell. You know, the problem is then finding the new place from the buying. I know a lot of people that are just selling and renting just to get that extra equity and value, and I don't blame them. And then like hopefully once the market stabilizes out, they'll go and purchase another home but yeah, you know, and you see the benefits of that with refinances. You know, with that extra equity, you can do quite a few things. You know, if you didn't do 20% down, you might have enough equity now that you can refinance and have that 20% value and get rid of your mortgage insurance. Or if you even have more so, you can cash out and take the loan to value to that 20% and then take out, you know, whatever cash is the difference between your mortgage and the new appraised value. So, you know, there's a lot of benefits to that. You know, even though rates came up, like I said, a little bit, they're still fantastically historically amazing.
Yeah, I mean, just for when we were in the process of purchasing our home, we were not offered less than 4.5% when I bought a house a couple years ago. So
exactly. Yeah,
that to be at 3 still is pretty good.
Absolutely. I mean, that's what I try to tell people. You know, it's understandably tough for the people that were, you know, in the middle of that when it was, you know, they were shopping at that time when rates were at like 2.25. You know, I quoted like a 1.875 at one point. You know, so it was tough for them to swallow the pill that, you know, went from the 2.25 to 2.875, 3.25. You know, but unfortunately that's just, you know, the way that it goes, because you know, and it's, you know, it's not a Greentree thing. It's not like we decided to rise our rates. Like I said, we're all tied to this 10-year treasury. Now, you know, different mortgage companies will have slight variances in their rates, and that's what you rate shop for. But I mean, I know my company, I barely get beat out by any companies for that. You know, I probably beat out 8 to 10. And those are for me, the reputable ones, because you'll see those, you know, internet companies that offer the low rates. But, you know, sometimes I tell people you'll just get a shirt that says I got quoted a low rate, but I didn't get a house, you know, so, but yeah, you know, they're still fantastically low, and I try to tell people that. I mean, you know, pre-COVID, yeah, 4, you know, rate in the 4s was fantastic, you know, on a conventional, you know, and my manager jokes when he was in the business, you know, like 10%, you know, he was doing 10%, 9%. It was fantastic. You got an 8%. So, you know, it's all perspective and from when you look at it. You know, but also what we see is, which is tough, and I wanted to mention this, was so second homes and investment properties, they've gotten hit very, very hard now. Originally, I thought it was to try to curb them, you know, from, you know, allowing people who need primary residences to, you know, to get a home, instead of the, you know, weed out the investors and people looking for a second home to maybe try to help the inventory there. But I think it's actually, so because technically Fannie Mae and Freddie Mac aren't supposed to be doing as many second homes and investment properties as they have been. So Congress kind of came in and said, look, you gotta bring those numbers down. You gotta curb that. So this may be a permanent rate adjustment where they've, added on additional like half a point to investment properties and second homes now. So
what are
yeah,
they hitting as
so
that number for if you're purchasing a second home or investment property? What is that extra point look like?
So like I had, and it was tough and I felt bad, but like I had a couple people, we were in the midst of the process. They were about to go under contract or were, but we, weren't in the rate lock time yet. And, we saw rates go from a 2.875 on a second home and to a 4.375. So, I mean, that's where I'm seeing rates for the second homes and investment properties now is in the fours, and sometimes having to pay for that rate. So, which again, historically still fantastic. I mean, that's normally kind of where investment properties and second homes were pre-COVID. I mean, if you got an investment property in the fours, that was great. Normally they were like 5, 6 sometimes, right? So it all depends, but yeah, that seems like that's going to be a permanent thing now that, Fannie Mae and Freddie Mac. So they're the ones who set the guidelines and the rules, like no matter what bank or mortgage company, if you're doing a conventional loan, we follow their rules, their guidelines. So that was placed on by them, and that happened in like the midst of that spike that you saw. It was rates. So that's why rates went from like the 2.8 to such a high jump of the 4.375. Because normally you see rates, it's pretty steady. It's a steady increase, maybe an eighth of a point every week or so. But it was such a dramatic jump that week because you had the sell-off and yield shot up. So you had the rate go up a point there, and then it was like that Friday or the next Friday, Fannie and Freddie made that announcement that they're adding that additional rate hike. So it was like those people in the middle of that really got slammed. So that was pretty difficult. But
do you feel like buyers should be, because I know you're watching this because this is your industry, it's good to be in the know of it. Do you feel like buyers should be kind of aware of that too, or should they be watching what those rates are doing to make decisions on purchasing, or it's not going to affect them too much because they still have to come through the lender?
Affecting them as far as what, like purchasing, or
there's really not much they can do about what the federal rate is doing, but they could be on the lender side, they could be working to make sure that they have the whatever their highest credit rating or credit score could be, so that they can take advantage of whatever Greentree's lowest interest rate available is, or something like that.
Yeah, definitely. I think it's good to be aware of all this stuff and to inform yourself. For me, knowledge has always been power, and I've always tried to inform myself and figure out, because sometimes the rules and stuff are stacked against us normal people, for those who make the rules. So I try to learn what they're doing and learn what's going on, so then I can try to take advantage of it as well as best as I can, not as much as them because it's still pretty stacked against us. But yeah, and having great credit is key, especially for those second and investment people. That's why I'm saying, like, you have to have like a 740 or above if you're doing that
to even get the 4% that you're talking about that they're seeing as high. Wow.
Correct. So I mean, investments, especially investment properties, you really always want to have high credit, because these things are, they're determined by risk, right? That's also what factors into rates, the overall risk profile. And second homes and investment properties are a higher risk because, say you lose your job, right? Which mortgage are you going to pay first? The one
the one I live in?
Right. Or the one that you vacation in or you rent out. So, so they see that as a significant higher risk. And, that's also too what you saw during all these guideline changes, trying to eliminate risk, as much as possible. That's why you saw the credit score requirements increase, That's why you saw some loan programs, go to rest until over, right? Like we're not currently doing 203Ks or renovation loans because those are one of the highest risk loans you can do because you're giving a value on a house that's not there yet until the construction is done. So, and that could be difficult, especially with COVID. So they put that on pause. Jumbo loans, I think are starting to come back a little bit, but they were kind of put on pause because, the banks wanted to hold on to their liquidity because they weren't sure what's going to happen with the economy with COVID. So they didn't want to start giving out giant lumps of money because they want it just in case, stuff goes bad, like, the housing market crash back in '08. I mean, and that's kind of what the fear was too. But I think they've put a lot more things in place now. They learned their lesson from that. And I think the Fed's done a pretty good job. I mean, because that was a big fear in all this as well. And that's why you saw the rate hikes and them just trying to eliminate risk, raising credit score requirements. They didn't want to see, because with all the unemployment, you had all the people going to forbearance or unfortunately foreclosure. So, and that's, what caused the crash. You had, it wasn't caused by what they call a black swan event like COVID, but it was just people who couldn't afford the house that they were in. And there was just a massive amount of forbearance and foreclosure. And I don't think they did the best job with the forbearance thing because they kind of just talked everybody into it and just called everybody, said, hey, you want to go into forbearance? I had a doctor I just spoke with, I helped him buy the house, and he didn't stop working. He made great income. But they called him and said, hey, you want to go into forbearance? And he did. And then, when the rates dropped down to the 2s, because he bought back when rates, were in the 4 or 5s. And because he was in forbearance, we couldn't do the refinance until he gets out and makes, 6 months payment on it. And he would have saved like $100,000.
Wow.
If we were able to refinance. So they just did a bad job explaining that and what they were going to do. People didn't realize or understand that because you take 3-6 months off your mortgage payment, well, that means you owe it at the end of that, all those months at the end of the period, which is crazy to me because it's like saying like, okay, you can't afford $2,000 a month for, 3 months, but within that 3-month period, you're supposed to save $6,000 to pay those 3 months back at the end of it. Well, why wouldn't you just pay the mortgage then if you could save the $6,000?
I had a client too that we actually closed that we earlier, or late last year. They offered, he needed it because he was his job let him go or let him his hours go, or something like that. And he reached out to see if he could take advantage of it. But when they told him well, within 3 months, you've got to pay it back. He's like, well, that doesn't really help me. If I've got to pay more, I'll just figure it out. And he was able to figure it out. But it wasn't, not enough people had it explained well enough. And if they took advantage of it and then they missed out on opportunities to reduce what they're paying over the life of their loan, it does suck just a little bit. Just a little bit.
Correct. I know it's pretty insane to me because I would think it's easier to scramble together 2,000, a month than 6,000 all at once. So that's the part I never understood. But what they've done is they've just tacked it on to the end of the loan. So you don't actually owe it back all at once, or but it wasn't properly explained. It was
just throwing it at you here's an option, you don't have to pay for a couple months, when in reality it's just going to bite you in the butt later.
Right. And which is odd to me why the banks would even want that, why they were just calling everybody. I mean,
perhaps it was just trying to be cautious but not really having thought it out. It's we have this solution for this huge problem that's worldwide, but not really having thought it out. And I think they've learned from that, which is why we maybe saw that hike instead of offsetting it so that people are essentially putting themselves in a position where they're going to end up being behind or foreclosed because that payment's ridiculous. Just making it so that it's still a little bit more difficult for people to buy if they're not in a good situation credit wise or whatever. I don't know. it keeps going, and you just hope for the best, and you still just hope that people are able to take advantage of whatever the good opportunities are out there, and just be informed as they do it.
Yeah, absolutely. Yeah,
Yeah.
like I said, just try to inform yourself. That's why it's good, some clients I share this, the 10-year treasury
Mm-hmm.
with. I say, watch this. This is, what impacts the rate. So you'll see why, I may have quoted you this rate one day, but the next day it's different. Um, I think hopefully it's going to be pretty stable at this level for a little while. There's still that risk of inflation. I personally think it's they're being a little dramatic about it, because I mean, if you look at some numbers, yeah, there was a lot of money printed, but people still have less in their savings saved up than they did prior. So I think it's just a jumpy market. Those investors are finicky people, but yeah.
It, well, I do appreciate you taking the time today to just first off I heard about the Fed rates, not jumping on it and just saying, yeah, rates are zero. Like I was always refer and recommend people talk to their lender just so that they understand what's going on. But that was some really great information and a great tool for even for me to just be aware of. And then also for potential people who are behind, that there's still opportunities for them, whether it's selling their home and taking advantage of all the bajillions of buyers who are willing to overbid on the properties, taking advantage of that so that they can sell their home and get out of this negative situation, as well as, the rates are still reasonable enough to refinance for homeowners who have high interest rates right now. So I really appreciate you taking the time to share all of that wealth of knowledge with us. And I, always, of course, do look forward to working with you again in the near future. But is there a way that people can connect with you online, or for if they're looking to purchase a home in the near future or refinance their mortgage?
Yeah, absolutely. They can either friend me on Facebook if they see this there, Matthew Bradey. Can reach me at my phone number, 516-643-8852. Find me on Zillow, all the platforms. But yeah, best number is just to call me, and we'll see what we can do to help. And yeah, real quick, like I said, I mean, best thing to do is credit, and just to arm yourself with knowledge, in all areas of finance, too, and because the you'll see the 10-year treasury is tied to what happened in the stock market as well, for any of those that follow that. Because all these big hedge funds were taking out margin accounts because the interest rates were so low. And then when they saw that spike and the yield rise, they had to close their accounts and sell off. So then you saw the stocks drop. So it's kind of inverted there. But credit is also the biggest thing, that's not taught in schools, is not really, and there's a lot of misinformation on that. The biggest one is every time I go to pull someone's credit, they thinking their score is going to drop down 20, 40 points, which is totally inaccurate. Your inquiries only makes up 1% of your total credit score. So, having a credit pulled or an inquiry isn't really going to drop it, that much. It will maybe drop it 1 to 2, 3 points. But also my job is to help you get that credit score as high as possible so we can take, the best advantage of those interest rates. And also, so, in this market, it's been very, very tough for FHA buyers. So we're trying to get people's credit as good as we can to switch them to conventional, so they have a little bit better of an option, because that's been a difficult thing we see. So, focus on that and reach out to me if you have any questions on that. And thank you so much for having me. This has been cool. I hope to maybe do this again.
Absolutely. There's going to be a pause here, and then you can hit stop, record, and then we can end it.
Bam.